Welcome to the Business with Beers podcast. This is the place where we help entrepreneurs expand their business, build their wealth, and generate passive income. I'm your host, Brian Beers, an entrepreneur who's on a mission to inspire growth from everyone around me. Remember that you need to take the actions others won't, and you can live the life that others don't. Please be sure to check out my weekly newsletter that now drops every Thursday. It includes one quote, one tweet, one podcast recommendation, plus some business and investing insight from me. It's short and it's sweet. My goal is to provide you with just a couple gold nuggets to help inspire your growth. Go to brianbeers.com to subscribe. Hi, everyone. I'm excited today to bring you Fred Hubler. Fred is the CEO of Creative Capital Wealth Management. He's an accomplished entrepreneur with more than 25 years of experience in both financial services and technology. He's also a friend and fellow Philly native. So welcome to the show, Fred.
Thank you. Thanks for having me. Try to say that fast five times.
Fellow
friend and Philly.
Yeah, that's right.
Good thing it wasn't another F word in there.
There you go. And for everyone listening today, we're going to be talking about alternative financial investments. So the idea is you make your money in your business, right? You're an accredited investor. Where do you go and deploy that capital? And we're going to be talking about things that are going to be outside of what most people traditionally think of: stocks, bonds, and multifamily real estate or whatever. So, and as a disclosure, none of this conversation is financial advice. You need to figure it out on your own or work with Fred directly. So. Cool. So Fred, first off, what is your take on the economy right now?
It's interesting.
June 1st.
I think there's pockets of things that are working better than they should. I believe there's still very choppy waters ahead of us. There's a debt bubble, both at most people's personal level and even at a corporate level and a government level. And that the debt bubble is global, and that's never happened before. And I think the market wants things to happen a certain way, so they've kind of telegraphed their wants. The Fed's job isn't to keep the stock market up; it's to keep inflation in check and employment at a good number. And I think in the employment level, that's where the unknowns are. I have had 9 to 10 months trying to find a white collar job, and they're not out there. I don't know where they are. And then if anyone has an unskilled restaurant type of job, they can't find those people either. So I don't know where everyone went. But you're seeing the layoffs, and technology companies are the ones that are usually first to lay off. Their only job is to look in the future. And almost every technology company has looked in the future and laid people off today. So I'm not making it up thinking it's going to be choppy waters. I'm looking at other people. The other piece that we look at is what people with a ton of money are doing. So the Warren Buffetts of the world, the private equities of the world, they're hoarding cash at a level never before seen. So those things are ingredients I use to say, okay, let's reduce risk. Let's assume, and I hope I'm wrong. I hope things keep going, but nothing goes on forever, and nothing really from an economic standpoint should, because recessions and depressions clean out the things in the economy that shouldn't have been happening. And I also think there's a ton of zombie companies still ahead of us, which are awesome companies, businesses, restaurants, places you just went to with your wife. Everyone was happy, food was great, things were clean, and they're bankrupt the next day because their capital structure, they're the zombie companies because they were only alive because debt was cheap, and debt isn't cheap anymore. So I think we're going to see a lot of that. And once that starts to happen, people are going to take attention, and the reality of life will be no longer, trumped by the narrative. Right now, the narrative is winning, and I don't believe the narrative. So,
man, you're scaring the shit out of me. And the debt's like a big problem, especially when you think about, people got, loans that are coming due, and then they got to refinance it. Now it's at a much higher number that, or they had a floating rate, which, was super cheap, and now it's not, there. Right?
One of the firms we use, 75 years, all they do is nationally, not globally. They just buy industrial. And their whole thing is we don't buy it unless we can buy it right. So they really want to buy it under the current value. They can't keep up with the amount of calls coming to them saying, hey, my bank wants me to add more capital for this construction job because it was underwritten at 2, 3, 4%, and now it's 4, 5, 6%. I got to come up with more money. My only asset's this industrial center I don't want to sell. And the interesting thing is, and I talked to the son of the owner, he's like, they're not asking, they're saying, how much can you give me? Which, there's desperation when they aren't saying, here's my number, or they're just.
So they want to take a loan against it?
Yeah.
Okay. Yeah. So they do like hard money or whatever, temporary loans.
Actually, this company will they'll buy it. So they'll buy it with cash
Okay.
Buying it because you're a builder that needs to come up with equity on your building that you haven't finished building. And obviously that's your next, full cycle, surplus coming in. And it's nationally, you have a lot of builders that just got ahead of, or the interest rates got ahead of where they are in the projects. And so now the banks are coming back and they're a little scared.
Gotcha. So they're selling their industrial stuff.
Yes.
To finish,
and not because they want to. So this company's getting the, basically lowball the number. And the few times the guy, and again, it was the owner's son, he's like, I gave them a lowball number thinking there'd be a counter number. And they're like, okay, can you close in 30 days? So now that's all we do is give them way lowball numbers. And he's like, if it was one time, it was one bad, bad situation.
Yeah, interesting.
It is happening everywhere. It's not making the news yet because most people aren't, there's no builder.com that you can go to.
And what kind are they, houses built?
So they're built
or office complexes?
Yeah. So a lot of it is the builder now is building multifamily because that was what was, demand there. But, 4 or 5 years ago, that's what they got the permits for. That's what they put the shovels in. And then their thing that they've owned personally was these industrial centers because they're just cash cows. There's no, it's fairly, how they work. And so that's, those are just pieces of the economy that we're not seeing in the news. And the pieces I'm seeing are not, other than this company's making a boatload of money because they have cash from investors and buying it well below, and it already has a tenant in it. And I like real estate kind of like you do, but I like the real estate that nobody wants in their backyard. So cell phone towers, mobile home parks, industrial centers, they're awesome because there's a built-in supply constraint because you can't build them everywhere.
Yep.
So there's always an opportunity. No matter how bad the news is, there's always an opportunity.
I reached out to our commercial banker, a regional bank here that we do a lot of business with, and said, hey, we're looking to buy another shop. It's an independent. We're going to buy it, make it one of our franchises, and asking, what are loan terms looking like these days? And he goes on to tell me that pretty much the bank has stopped doing loans, except for existing clients that have more money in the bank than what the loan amount is for. Which is like, well, what's the point
of the loan?
Yeah, why do you need a loan then if you got the $800,000 or $1 million or whatever it is?
That's not how loans work.
Yeah. So I was like, he's like, well, we can get it done like pretty quick though, because we got a bunch of guys sitting around doing nothing, and like these guys are gonna be unemployed soon because we got a whole room of people doing no loans. Like,
yeah, and you're seeing that. People got scared.
And I put that on Twitter, and a whole bunch of people responded saying pretty much the same thing. Yeah, they're super tightening up. Especially on the commercial real estate side. Obviously, we're in a space that's a little bit more resistant with all. And
there's a lag from that happening to you to that being seen in the numbers that we see on the news. But those things are already happening. Money supply was already negative. Every other time money supply was negative, it was in the middle of a recession. This time, we don't even feel it because there's so much money. Negative money supply is just taking some foot off the gas, but we're still going over the speed limit. So interesting times. Whoever ate the fortune cookie of may you live in interesting times, I'd like to strike.
Yeah, right. So then what, all right, so let's get to the investment side. And so what are you like doing personally / recommending your clients, depending on their situation?
So I touched on one. I did write an article in Forbes about it, but asset class that's been underutilized and isn't anymore is cash. You can get cash on Apple 4%, and it's on your app. And so now cash is no longer the 0.25 while inflation is whatever it is. So cash is an asset class for obvious reasons. You got dry powder. It's a stabilizer to a portfolio. And 4% doesn't sound like a lot of growth, but if it's 4% or the market's down double digits, I'd pick the 4%. It's like, you're comparing it to the wrong number. If it's not enough compared to what? And that what hasn't happened. So cash is the big thing. Any place where there's a value add component. So it could be real estate, but it's not buying the mobile home park from 2022 and hoping it's worth more in 5 years. It's buying the 1982 mobile home park and adding better embellishments to the community areas, and
or developing a bunch of pads. Right, that aren't underdeveloped.
Yeah. So any place that is value add. The other place from a stock standpoint is the thesis no one talks about with the stock market is buy, hold, and then you hope. Because there's nothing, if you and I buy all the Tesla shares we're not moving the stock. However, if you that same money goes into a private equity fund, they don't buy, hold, and hope. They don't buy unless they know what they're going to do to turn it around. And it's almost like real estate, but they're doing it at a corporate level. And so private equity has a ton in cash, like I mentioned earlier. When things start to go down, they're the ones buying those zombie companies.
Yeah, they're the ones that are got the powder ready to rock and roll.
They're great companies. Bed Bath & Beyond's a good example of a fully loaded store. It's not like the old retail centers that, JCPenney, we walk through and like, wow, how's this place still around? These are stores that are like
financial turmoil, not like business turmoil or operational turmoil. Yeah.
So any place there's value add, there's a bunch of components. Real estate, private equity. The other place is any place where there's an unfair legal and ethical unfair advantage. And this is right down your alley. One of our clients owns multiple quick service restaurant, franchises.
Okay. Yep.
And it dawned on me that if he wants to put another one in your town and I want to put one in your town, he has 18, I have none, I'm never going to get a chance. They're always going to give it because
that's the benefit of a franchise. Yep.
The franchise companies are kingmakers. And as long as you've proven that you can take one shop and make it 4, then no one else can really compete with you unless they have 15, but for the most part, it's almost like the airplane that can't get through the cloud bank. But once you get through, it's easy sailing. So I found a firm that, and there are other firms out there. So again, it's not, it's a teaching, not selling type of moment, but basically they buy from aging baby boomers franchises of the kind that they focus on. So again, but basically they only buy 3 and they're all fast food, but they're all 3 fast food, but they have 120 restaurants already in this fund. So the retiring,
are they all from the same, is it like the Taco Bell?
Yeah.
That family,
the
Yum Brands,
Taco Bell, KFC, and Dunkin' Donuts.
Yeah.
Diarrhea trifecta. So they know those systems, really well. And you can sell as a seller, you can sell the franchise anybody you want. But guess what? They're going to suggest that maybe you sell to a firm that runs it like a business, has 120 other buildings in the area. So it's not like you have one over here and 15. Do
they operate them too?
Yes.
Okay.
So someone doesn't show up.
I've been pitched. Someone's pitching me on that, saying, "Hey, this is what we should do. Like, we should go out, create our own fund, like make our shops, contribute our shops to it or whatever as the founding thing, then go raise a bunch of money and then use that money to go buy more stores and maybe some other subsequent brands. But then we're the operator too, in addition to,
we should talk.
Versus like other private equity guys go and just, they give them money, but then like that other person, the private equity company is more just a financier than it is.
They're aggregating it to sell it to someone bigger.
Yeah. Just to flip it to somebody else versus like the operator himself, then having it. And for us, I mean, we're thinking, is it, I don't know, do we need the money? Obviously you'd have to go huge, right? For us to make sense, like it'd be
120 is a good size, and
triple in size, right?
Done at 300.
Yep.
So once you've turned these places around and their EBITDA is a great number, that's the factor that they sell it to a big institution. So eventually it is not a perpetual fund. It's not a mutual fund. It's no stock market. And frankly, I'm more concerned about the the upper echelon of steakhouses in this next turnover than I am about quick service. If anything, I'll eat more at Dunkin' Donuts because I'm not going to go to Ruth Chris's for a $20 hamburger. They might not be open and it might be a $30 hamburger and they might have no one to deliver it to me. Those types of things are out there. It takes research. And here's the thing that I think all of your listeners should understand. And 20 years in the business, it was my first year being independent. If you ever felt the rich got richer because they know things the rest of us don't, the answer is not only is that true, it's a government program called accreditation. So all of the things that we specialize in, for the most part, and since not everyone of your listeners are accredited, I'll talk about non-accredited strategies that kind of get you similar. I can't talk to someone about, I can't show them the PPM, I can't show them anything unless they're already accredited. And the rule kind of says they have to already have a relationship with me. So we do planning for clients and we do real planning. So it's not just a check off, and that gets us access to it so that then we can see, get access to their information. So it is really restricted. And then the other thing is they're fairly small deals, $200, $300, $400 million. Vanguard just made that why I told you that story. So it's a completely different scale. And a lot of times the companies that we work with have a finite number of offices they use because we're filling up anyway.
Yeah, they're gonna fill up. So it's existing guys, the relationships you put out to you. You've got your 10 or 15 guys. Boom, the whole deal's done. And
I've been doing it for 20 years, so I get, hey, do you want this? No, I'm good. Oh, yeah, I do want it. Yep. And then guys I know in the business, like, I didn't even know that it existed, and by the time you told me about it, it was sold. Sorry. So it's again illegal and ethical.
And so what's what are the barriers to get to accreditation? I know there's a couple
$1 million,
different ways.
not counting your house.
Yep.
180 of individual income or 300 of joint income.
Got it. Yep.
And for some reason, the government thinks you're smart if you have that. I've met a lot of people that satisfies those numbers.
Yeah.
And they're not smarter than the guy making 40 grand. They just happen to have more in the bank. So I think it's an unfair advantage, but I understand why everything we do is typically has a liquidity lockup that you can't get out of, even if you needed it for a liver transplant. And then my job and my office's job is to make sure we're not putting money for your kids' braces in something that might live for 5 to 8 years. And we don't.
Plus, it's protection. I mean, the circles we run in, obviously, there's a lot of trustworthy people, but in a lot of others, they'd be preying on people to sell them a great deal, and then there's no way to vet it, and they can't
Yep. And we don't make anything. My MBA was based on best of breed, so we get access to very large institutions of national brands you would have heard of that literally wouldn't return my phone call when I started, and now they're calling me saying, "Here's what we have. Do you have any?" And it's awesome to be on that. It's awesome, just like you did. It's awesome to be on the other side of the cloud cover, because now you have different options. You don't have to, also mop the floor of your office. You got people to do that kind of stuff, and you can foster the leverage that you created in the thing that you were doing. So it was funny. I thought I was in left field doing alternatives in literally Vanguard's backyard. I'm just ahead. I was ahead of the pack, and I didn't move, but the pack kind of moved here. So now alternatives are a hot thing. I don't know what's stranger, that I'm a contributor for Forbes.com for the alternative space, that they picked me, or that they didn't have one before me. That's a Forrest Gump kind of in my head. I'm like, I don't think too much about that, because then I'm like, I'm saying things and people are gonna,
I saw this meme that, I don't know, Elon Musk posted a while ago on Twitter, but it was like, he's like political stance, he's in the center, and it's like, it's the last like 10 years, and then like the whole entire system has moved over, I guess mainly to the right, of course, but
and he hasn't moved
to the left. He hasn't moved, but now his view that when I was center is now like somewhat conservative, and now it's like whatever, I don't know, whatever.
Same idea. And someone told me, like, you probably have done this as well. Hugely successful people have always done 3 things that I didn't know I was doing, and I think you can probably equate to doing this sometimes. They're a contrarian. They're right, which is mostly not true. Most of us aren't. Most contrarians are completely are contrarian and wrong. And then the third one is they take massive action. And I wasn't trying to do those 3 things. I just was doing those 3 things because it was something I believed in alternatives. I'm in Vanguard's backyard, so I'm not going to compete with free. In people's heads, oh, that's free. I can just be in the market. All right, why don't we not go in the market? And the contrarian thinking is not really contrarian when you look at Harvard and Yale have 80% of their money in alternative investments, not in the stock market. But it is contrarian to Joe retail investor who has it all in index funds. Low cost index funds, nothing wrong with that. But, when things go south, again, I'm not worried about Harvard and Yale because they got real estate, they have private equity, they have things that actually go up when things go down. Joe Blow, equity fund ETF guy, he's going to go down with everybody else. And that's a shame.
So I know you can't give any specifics, but in terms of ranges, how does some of these alternative investments perform compared to what people traditionally think of stocks and bonds?
So non-correlated to the market, which could be good and bad. So 2008, we were, some of these things were positive 6, 7, 8%. Market was down 30.
Yep.
2009, the market's up double digits. We were up that 6, 7, 8% back in the day. So it's non-correlated. And sometimes, why is this doing so bad? To, oh my God, how's this up and everything else is down? So it's definitely, there's a lot of Bernie Madoff conversations in a funny way, because I've never before, because alternative investments won't have fact sheets and Morningstar reports. So to answer your question, we triage it. What's the purpose of the capital? Is it income or is it growth? Yep. And then is there a need for tax abatement? Because there's tax credits that give you great income. There's tax credits that don't give you great income, but give you tax-free growth at the end. Opportunity zones are in there, obviously DST. So the short answer is, depending on what they want it to do, there's no investment that gives you great income and great growth. Like, they are mutually exclusive. Personally, I'm in a value add real estate investment that's 4% a year. I just told you cash at Apple is 4% a year. So that's not the reason I did it.
Yeah.
It's generating more than 4, but it's using that extra money to build out the community area and the extra pads. It's a mobile home park.
Yep.
And so when we sell it down the road, I don't control it. I'm on the plane. I'm not flying. I'm just hoping that we land. But when the sponsor, whose job is to do the job and then sell it and sell me another one if I want it, they're going to be selling a nicer mobile home park with more pads. That's got to be worth more money than what I bought. So I didn't need it for the income. Fast forward, someone who's retiring and they want to replace their $200,000 of salary with passive income. That strategy isn't for them. So we have ones that pay closer to 7, 8, 9%, and that's pretty much what you're going to get. You're going to get a little bit back, and your money back, and a little bit at the end. But you have to have the asset aligned with the client's risk and obviously the time frame, but also what you want the money to do. And the hardest part for me is when clients change their mind. Oh, did I say income? I really want growth. Well, guess what? You're on the plane for income.
Yeah.
When the plane lands, then we'll get the growth. Oh, we'll do growth somewhere else. The only exception to that, and I think it's a short-term exception, and obviously it's, there's the road to hell is paved with good intentions. So obviously there's a risk there, is oil and gas investments that aren't the tax credits tend to have high low double-digit income while you're waiting. And depending on the price of the commodity, when they aggregate these parcels and sell it upstream, a pretty decent pop at the end. So the oil and gas, have decent income and fairly respectable, double-digit pop at the end in addition to the income. The risk there is what's oil going to be when they go to sell it. That's a risk. I don't think oil's going away. I think we've learned that Greta isn't in charge of our oil. I'm happy that Europe didn't freeze to death, but that was definitely on the table when you moved everybody to oil and bought oil from the place that now you're saying is a bad place. And the analogy I have for climate change, I have kids. I love my kids to have if we roll up our windows, but we're in a convertible, and the convertible is still open, and by that example, oil. What China does is the roof. They were putting 300 more coal power plants. So we can go to no oil at all, and it won't make a difference.
Got it. China controls the roof. We roll down the windows. Doesn't even matter because the roof's still wide open because China's doing whatever the hell.
They don't care. And frankly, it's the same world. So it's not like it's our
world.
It all. And that to me only hurts us as a country and benefits the rest of the world. And I had the thought the other day, we are so advanced from a capital structure, although we hate our, politics is ugly, it's still better than other options that are out there. So the rest of the world really can't catch up. So only way that they compete is by slowing us down and letting us self-hurt ourselves and, fight about whether or not what oil and, all cars have to go to electric. And then, California said that. And then they said, oh, by the way, if you have an electric car, don't charge it because we need it.
Yeah. We need power for our homes, so we were not allowed to plug in your car. Texas did that too back last summer.
And that's just asinine. So anyway, so I think there's going to be some dislocations in what people have been told is going on, and how business owners and how people who have the money are actually doing it. Like, follow the money, and you're going to see that some of the people saying climate change is real have beachfront properties. That's the facts. I mean, so how real is it? Anyway.
Yeah, of course, I'm like
not a political show, and I am not trying to be political.
And I'm obviously into oil and gas and car driven and EVs, and there's a lot of fear. People say, oh well, our business is destroyed by EVs. Well, like EVs still need a bunch of work of unknowns, right? Like even your Tesla, right? Like I don't know how many miles you have on it, right? How many?
34,000.
34,000, right?
And at some point, it could use a new battery, and you might be the place I go
so you have
to
that,
buy battery.
But then like the average car that we work on is like 100,000. We see 150,000. So like we have no idea what the average person beating the shit out of a Tesla is going to need at 100,000 or 150,000 miles. Probably going to have a whole bunch
cheap, and I'm not doing it. So
and they'll have a whole bunch of issues, right? So like, I don't know. I think it's funny, but I don't think it's going anywhere either because of all the infrastructure reasons and all this stuff that nobody likes to talk about.
Yeah.
So they
And
just want to
infrastructure is a good investment. We have, and there's infrastructure mutual funds out there.
Yep.
I would say institutional real estate, there are funds out there that do it. I would say don't bet on any one asset class because it's going to be a sea change. But any kind of real estate that's not too big, and that's really what the issue is right now. Is some of these funds got so big because money was coming in, they had to buy whatever they could.
Yeah, to put it to use. Quality. Yeah. How are some of those? So I know, a DST, and you can kind of explain what it is, but it's kind of like a syndication, right? They raise a bunch of money just at a high corporate level, right? And go and do something huge like an Amazon warehouse.
Right.
How are some of those performing nowadays? Because when I looked at it with kind of a couple of years ago, and they were like 4% cap rates, super low cap rates. That now with interest rates rising and stuff, how are some of those shaking out? And I know they're shutting down warehouses.
Yeah. So a few things. One, the DST lets you own it as real estate so that when you either can 1031 in, and that's really why when it was, 4% revenue for the client, like I'm doing, it wasn't so much the money. It was the fact that I'm keeping all the money and all the gain, and I'm getting.
Got it. Okay. It wasn't cash flow play. It's a tax deference play.
So that's one thing. And you can get into a DST either with cash, and then from that moment forward, it's real estate, or a 1031. A lot of people are taking chips off the table. I was on, I think, seeing Yahoo Finance or something, but my story was the rats haven't jumped off the Titanic, but some people in first class have already gotten on the lifeboats and left. And what I mean by that is last year we did 18 families sold their marquee property, $40 million storage, whatever it was, and sold it to whoever they sold it to, and then used us to deploy into multiple DSTs. So you get more diversification.
Okay.
To answer your question, there was a time when the interest rate spiked that the only DSTs on the table had zero debt, which is fine if you're adding it to cash. It was why I had gray nose hair, because you have a 45-day window to redeploy it into an identified property, and you had a 50% leverage, and now there's nothing there. Since then, they've gotten, they're now levered, and it's fixed leverage. So we all think we're all counting on interest rates going up because that's what kills you if you don't count on it, and it does.
Yep.
And worst case, if it goes down, you get refinanced, but you don't want to refinance up. So the DSTs are still single-digit incomes on the lower end. The double-digit growth, I think, still on the table, not so much because of financing and interest rates, but I think inflation is real. And in 5 to 8 years, things will be worth more, even if you didn't do a value add, because it's just going to be worth more. And then if you have a quality property, and then, so my concern with most of the smaller rentals, and I'm based on those 18 families selling their marquee legacy, I sold my Phoenixville townhouse because whoever I have as the tenant is not going to be as creditworthy as an Amazon or as any of the more diversified institutional things. And I don't have to worry about it. And at the end of the day, I think the layoffs that are happening at the tech sector will come down to non-tech jobs. And then you're going to have a inflationary recession, which means your cost of holding that property, the taxes and the lawn care, if you have to pay for that, that's going up, and you may lose a tenant. And then you're fighting for tenants, and you have to lower your rent enough so that they want your property more than them. So all the numbers that are variable are going to go the wrong direction if the economy starts to go the direction everyone's saying it might go, and most likely go, and hasn't gone in a while. So it is overdue to go. I didn't want those concerns. So most of getting back to the other question you had, in everything we're doing for everyone, we're trying to reduce the risk and increase the quality of the thing we're owning. So instead of just being blind in the stock market, let's do some private equity. There's a lot of products out there that you don't need an alternative investment guy that are buffered annuities that give you a downside protection, and either unlimited or 300% upside. That's a covered call, but you're doing it at the insurance level, and they're doing it for everybody in that month's purchase. Qualified money, that's an awesome place for it. That way you're keeping in your capital gains that you had, not that you pay taxes on it, but you're keeping your gains and then moving in and then buffering it. And if you do a 6-year, segment S&P, I think it's like a 98% of the time in 6 years increments, the S&P has never been more than 20% down. So you're getting insurance for something that's real and an outlier. So there's definitely smart ways. The other thing that you don't need to be accredited for that you could look at is private preferred stock. So these are public companies that are offering, 5, 6, 7% income preferred stock, but they're offering it privately so that you don't have the stock market, the common share volatility. It's like a CD in the fact that it's tied for 5 years.
And it's kind of like debt, like it's a coupon based one, like it's a fixed income.
So it's equity, but it's equity that's above common. And it's one of the questions I would have gotten wrong in Financial Jeopardy if you said, can a public company offer private shares? My knee-jerk action was, of course not. Private companies are private, public are public. The answer is they can if they want to. And so most of them are real estate based. And the reason they're doing it this way versus going to Goldman Sachs and getting $100 million, stock offering and walking away with 90 of the 100 because they take their 10%, is they don't have enough property for $90 million. But if they do 25 million a month until they sell out of what they want to raise, they can absorb that. They have a project for each of the tranches, so they're offered monthly.
How do you find those?
So you can Google them and you'll see them out there. The downside for the normal investor is the company offers it directly, but not directly to the investor. You have to use a firm that they've authorized, and it doesn't have to be anybody, but you don't have to be accredited to get into it. That's the issue. We use that.
So they have to work through you or someone like
it doesn't have to be me. Someone like me. They're small minimums, 5,000, 10,000. Like they're not big. They're just a way of being a little bit smarter with the money in the market. You're only going to make the 5 or 6%. There's no upside and there's no market risk downside. And you have to wait 5 years to get the money back.
Yeah. How much like diversification do you guys recommend? Like someone, because like you could get involved in and spread out all this money in like all these different places, right? And then it's kind of like, what if you just like focused on 3 things that like accomplished your goals and like, I don't know, like.
Yeah, we have a very simple playbook for 2 reasons. Yeah. One, bigger clients don't want to have $110,000 things.
Yeah, K1s or whatever, like all this crap that then you got to track and look at it. And it's like.
Upkeep of it, there's a cost there. Now, I'm not paying it, but you're paying your accountant. Say, it's K1, 25,000 you did with this guy. So we have, our playbook is simplified. About 70% is exposed to the market, is liquid, because 20 to 30 is the max you can have in alternative investments. DST being the exception. If you're selling a $40 million property, it was already illiquid. You're just going
like the government says that.
What's that?
The government says that.
Yeah. In Pennsylvania, no more than 10% in any one, and in average, no more than 20% unless there's extenuating circumstances. So 30 years old, you got a ton of money, and you don't need a lot of it. We can probably go closer to 30 as long as.
And is that of someone's liquid? Like, what if they own real estate or a business that's worth a certain amount? Does that factor into it? So
it has to be liquid net worth. Again, real estate is calculated different. So if you have $1 million of real estate that you want to sell, you're allowed to put 100% of that $1 million into DSTs because the advisor didn't increase your liquidity. If you come to me and say, here's $1 million of cash, 30% on the high end is what can go into these alternative investments. Now, my brothers who do syndications don't have any of those rules. You can take $1 million.
Because you go direct. So like I've done a bunch and I just go, I find guys that we know, right? And I go invest with them directly.
They don't have the same rules. They're under.
I could put 90% of my liquid net worth with these guys because they're not financial advisors or whatever.
They're not
like you are. Yep. Got it. Okay. So as a fiduciary, that's what you're capped at.
Yeah.
So someone comes to you, you find all the good stuff for 20 to 30 or whatever, the stuff that the other guys can't get. And then they take the other 70 to 80 and go do whatever they want.
Do that. Or we do the 70 to 80 that we do handle. If they want to handle it all, we'll do market exposed money in a smarter way. So most funds are in the same stuff and you can't control the overlap. So if someone has $1 million to invest in the market, we partner with a boutique firm that will buy and build the Brian Beers individual security portfolio based on the risk profile. So, and we can have quarterly meet, hey, why'd you buy Apple that day? Well, here's the numbers. And, the VR was coming out and we feel that it's going to be, so there's ways to do it. Plus you can use non-alternative investments for that 70. So those private preferred stock doesn't come out of the 30, it comes out of the 70.
Gotcha. Cause it's still stock. Okay. So so that's part of your playbook.
And that buffered annuity is not considered alternative, So there's the ways around it in a way that doesn't violate it, but it is definitely frustrating when someone says, I can give this other guy $1 million, I can put it all in the real estate. Why can't you?
Yeah. You say thanks. You say thanks, Biden.
I'm licensed. He's not. I'm a fiduciary. Yeah. I'm sure he's good, but
What do you think about gold? Physical gold.
I own it personally. Everyone I know that is a gold bug never sells it, even when they should. So why do you buy gold? Because it's safe. During COVID, why aren't you going to sell your gold? Because I need to be safe. Like, well, what's the point of it? I don't buy it because I bought it because I like to have it, and it's not a big piece of it. I have more in Bitcoin and crypto than I ever will have in gold. Because if we are down to the point where we need gold to transact business,
Yeah, we're screwed.
Yeah. And I did get the gold that's like, it has like a little chocolate bar. You can snap it off. But again, I just thought it was cool.
I need I need a new computer. So,
Yeah. My Bitcoin, if I can't get in my computer.
We trade this cow for this piece of gold that I'm going to take.
1031 that one cow for another cow.
Or 19 chickens. Yeah.
There's money to be made there. What we like to do is part of our 70%. We can have options traders for our clients.
Okay. And I've heard the non joke of what we just talked about, but it was more of like, if some of these countries go back to gold standard and like Russia and all these, I don't know, they use it kind of like as their, reserve. It becomes the reserve currency or reserve backing.
Yeah, no, it's definitely, I think it's going to be.
That would be the reason it would rise, not necessarily becomes our form of currency.
Yeah. And I think the issue, right? Gold, you won't have enough in gold to offset if the dollar is no longer the currency of the world. The damage it's going to do to our currency, our values,
more than the amount of gold you could.
When British lost the British pound, they also lost being a superpower, and they're never coming back. Yeah. And so, I'm not saying we're Rome, but we rhyme a lot with what's going on. What's going on now rhymes a lot with Rome. And I'm hoping it's wrong, and I hope we last more than the 250 of most dynasties.
You never know. But that's all right. We just keep plugging away, trying to worry about the things that we can control, right?
Yeah, make enough money that it doesn't bother you.
That's right. Yep.
For you and your clients, that's all you got to do.
Awesome. So cool. Thanks for your time today. I know I could talk to you for hours, but we're going to wrap it up. So where can people connect with you if they're interested in learning more about the services you guys provide? Yeah.
So there's two things. For a primer on alternative investments, I would recommend you go to got-alts.com. And that's a landing page for all alternative investments. It's educational in nature. It's my page, so I'm not, but it's not my company. It's just a informational page. And then my company is CC, like cat, WMG, WilliamMaryGreg.com. It's what's behind me, Creative Capital Wealth Management Group. That's how you talk to one of the strategists. That's how you make an appointment. You can see stories about it, profiles of who we help. We're in 28 states. We can be in any state we want to be. And on that front, we do two things. We provide access to those alternatives that we talked about. And then to anyone, we can do retainer-based planning, which means the money stays where it's at, even if it's in your 401k because you're a director at a big company and you haven't retired yet. We can give advice on that without that money having to come to us, which I think is weird now. And in 10 years will be the way the world is. So again, I'm in left field, but eventually I'll be head of the pack because I think it's going that way.
Yeah, which is a much better approach than pay somebody 1% that compounds forever. And yeah.
Well, the straight face, they'll say, okay, here's how you work with me. Give me your money. I'll charge you 1%. I'll put your money in harm's way, and then I'll give you advice. And the advice probably should have been, don't give me your money. That's the world with a straight face. Yeah. Every other advisor is like, well, that's how I do it. We're like, hey, leave the money as that. We'll charge a retainer. We charge it quarterly. We'll give you advice on anything, anywhere. And in most cases, they're not retainer clients for 5 years because they got their stuff together. And eventually they may need alternatives, and we'll do that in addition, but it doesn't have
to. Got it. Okay. So it's more of on a planning basis to help get what someone's.
Yeah. It's like a family office, or people that don't want to give a family office money because they have it in their businesses where they belong, but they don't have someone they can trust and say, hey, I'm thinking of structuring my comp plan for my employees like this, or how do I do a top hat plan? We do all that for them and then give them the analysis. Even if we don't do the work, we'll do hey, we've seen it before. Here's a sponsor we've used, or here's a third party consultant that can set this up for you. That's why we're in 28 states, because we're not needing money to come to us to manage.
Yep.
Eventually it does anyway, because I would like to have a tax credit. I'd like to have a Amazon.
Yep. Awesome.
Cool. As you said, we can talk too much, so I'm
CCWMG.com, Creative Capital Wealth Management Group. Well, awesome, Fred. Thanks for coming on and sharing, your story and, having this conversation got me thinking about a lot of things. I'll ping you about a couple of these. So It's been fun.
Wasn't my intent though, but thank you.
I'll see you.
All right, take care. Bye.
That's all we got for this episode with the Business with Beers podcast. One thing that would really help both us and other new potential listeners is to rate the show and leave a comment in iTunes, Stitcher, wherever you listen. Also, make sure to link up with me on your preferred social media platforms, LinkedIn, Instagram, Twitter, Facebook. You can find all my links at brianbeers.com. Please just share the podcast with anyone who you think might enjoy it. And until next time, remember to take the actions others won't, to live the life that others don't.